All right. Hello, this is VDL Value Don't Lie. I'm going to talk through this Peabody Energy BTU post that I sent out a couple days ago. Um, just full disclosure, I am a total tourist, newbie, rookie, whatever you want to call it, when it comes to looking at coal stocks. It's not an industry that I'm super close to, so take that with a grain of salt. I thought this was an interesting idea. One, because I love these flatlining charts, right? So several years of just pretty tight trading range. So you can see this is, call it 20 to 30 bucks a share for many years. Now it's starting to dip below 20. So people are casting their vote for this acquisition that they made, right? So that's the story here. These guys acquired or are acquiring these assets from Anglo. They're trying to get out of the coal business. So 2.3 billion of cash consideration plus some contingent stuff, right? We've got this offline mine that dealt with a fire. If they can get it back online, there's some contingent consideration that comes with that, right? So 2.3 billion, and everybody in the space is running with net cash balance sheets, right? And buying back stock, dividends, whatever. And now Peabody is doing the opposite. So they're actually out trying to buy stuff. And so that has people kind of questioning it, I guess. So what I think is interesting in my post, scroll down behind the background info and everything, I'm thinking about it in kind of three different buckets here. One is, what's the core BTU business doing, right? Like, how's their actual legacy business look? What are they getting from the acquired mines from Anglo? And then three, they have kind of these I would call them like two call options in more EBITDA cash flow down the road. One is a new build mine that they're working on themselves, and they expect that this is that Centurion mine, expected to do 3.5 million tons of met coal by 2026, and then the Anglo mine that's offline could add 3 to 4 million tons a year, and they're quoting that at $65 to $70 EBITDA per ton, right? So those are kind of the assumptions that go into it. And there's tons of detail that I don't have, that I haven't dug deep enough into, right? Like the types of coal pricing that they're going to get in those mines. But all that stuff I think you'd want to dig deeper on. But I think this is the right approach, right? So look at it under these three buckets. And then I think the big challenge behind that, I did some math here, just some scratch math, is that you're looking at those three things, and because they have all this debt, and because people are worried about this industry in the, like, maybe not the 3 to 5 year outlook, but the 10 to 15 to 20 year outlook, you're basically saying, okay, we're going to spend the next 3 4 years repaying debt, and then maybe we're a debt free business by then. So what is that, 2027, 2028 timeframe? Then you look like everybody else with a net cash balance sheet, at which point you can say, okay, great, now we can turn on the buybacks, now we can turn on the dividends, yada, yada, right? And then hopefully at that point in time, you're trading at like a 30% free cash yield or something even better. So you're basically, it's like the marshmallow test, you're deferring your consumption until a later date, but hopefully the reward is even bigger. So I think that's what we're staring at here, right? So here's how I'm looking at it. The core Peabody business, they've given us some guidance. This is an all-in EBITDA per ton, and I just kind of used here's where we've been, right? Let's see. Here's my per ton metrics. Per ton, it's at 10, but if you look at the last quarter, it's down to like 7 right now. And if we look at analyst estimates, here are the estimates for Peabody standalone. I don't think anybody has their Anglo numbers in there. So 838 for 2025, right? 838, 838 million. So I'm calling it 800 million for core Peabody. Okay. And I'll come down to this other free cash flow bridge stuff in a minute. The Anglo deal, so they're talking about 11.2 million tons by 2026. So I guess this is free cash flow bridge, but this is by 2026, right? This is all by 2026. So the Anglo deal, what they're getting, the headline is we paid 3x EBITDA, so that implies like 700 to 800 million of EBITDA. but I caught some stuff in the call, uh, and I haven't dug deep enough to truly unpack all of it. But there was a line of questioning in the M&A call. Let's see, where is it? Basically implying, hey, this would actually be more like 45 to 50 per ton, right, for EBITDA, and unless or until pricing course corrects, right? Because they're in the deck, the 65 to 70 per ton of EBITDA is at 225 per ton benchmark pricing, and I don't think that's where they're at. I don't think we're there yet. What did they say? They said benchmark pricing is this premium HCC. So here we go. At November 4th, it was 203. So yeah, I don't know. That's what, like 10% lower, right? So yeah, okay. I don't know. Maybe it doesn't put it all the way to whatever I had in my numbers here, 46. Maybe I was being overly conservative. Let's call it 50 per ton. I'm just trying to stress test this thing a little bit, right? Okay, so say Anglo actually does 560 million of EBITDA instead of the 700 to 800 they're talking about. So these things I think are maybe more realistic, right, or more known by 2026. And then the option stuff, the two mines that they're working on, is maybe lesser known, both in terms of how much earnings it can produce and the actual tons that they'll get out of it per year. So I'm just kind of ballparking, used a similar EBITDA per ton. I called it 6 million tons produced annually, right? So that's an annual number. And then I just kind of reversed into a revenue number just to get a ballpark for CapEx and stuff. So I said 300 million here. I know in my write-up I called it 865 for the core business, and that's a 24 number. 730 to 780 million for the acquired mines, and then the call options at 400 million. So that got to 1.6 billion. 1.6 billion for the two businesses and the 400 million of optionality. Okay, so that's how I described it in the write-up. Maybe just talking maybe more of a blue sky scenario there. So that's the backdrop. This is maybe more conservative even than what I wrote about, because this is all in 1.67 billion, even with those call options in there. So got an EBITDA number to start with. Interest expense, I just took the last Q run rate, which is like 50 million. All they have is this little convertible note. I know that I said, here's the EV, 1.9 billion today, share count's 122, but technically this 300 some million of debt is a convertible note, 16 million shares. So maybe you could call it 770 million in net cash if you really wanted to, be aggressive with what your EV calculation is. So interest, and then I said, okay, they're going to borrow 2.1 billion. That's that bridge loan. I just said 9%. I don't know if that's a going rate. I just kind of picked a number that felt right just to get a starting point. Okay, call it 240 million of interest. CapEx. So I looked at history. I looked at the last couple of years. I used 5.5% of revenue, and we can see here this is since 2016. It's jumped around a bit, but this 5.5, kind of feels right. 5.5 is the average of these years, kind of pulling out these low years as outliers, and then the TTM number includes some of the build out for this new mine, and I believe they've said Centurion, approximately 250 million of the 490 million capex has been completed at September 30th, so that leaves $230 million or so, 240 million maybe. So that's how I got to a capex number here. So 5.5% of 6.25 billion, just taking 2 billion from the Anglo deal, and then the 4.25 that they're already doing on a TTM basis, right? That's really, really simple how I got to that. And I'm gonna actually call that 240 million. And then taxes is just the sum of these things times 25%. I know that's assuming capex and D&A are the same. I don't know, and I don't think they are, but whatever. I'm starting with something. They're not the same. That's okay. Okay, so call it 136 million of taxes. That got me to a free cash number of 400 million. right? From that, they've got some contingent consideration they've got to pay, and then they want to pay down that 2.1 billion of debt. So that's $3.35 a share on $20 stock. What do we got? Let's do math. Not times. 6x, right? 6x free cash. 6x free cash under that scenario, and that's just including the core business, and then a lower number for the Anglo deal. Okay. And really, I don't know, you could call that into perpetuity, whatever you want to do. This CapEx number probably is hopefully a tad high long term, but you never know what their plans are going to be to continue building out these mines. Then I included the options, right? And said, okay, let's do all three of these scenarios. I took debt down to $1 billion, right? Assume in 3 years. So this is maybe more of a 2028 exit, right? 2024 exit rate. So assume we got debt down to $1 billion, 9% plus the 50 from the convert. I know that thing will convert by then, but whatever. CapEx, maybe we're down to a reasonable 5.5% sustaining rate by then. And then taxes, same thing. It's just the sum of those times your tax rate of 25%. That gets you to $850 million or $7 a share. And it's a $20 stock. So 3x, right? 33% free cash yield. So the challenge is now you're saying, okay, well, I got to make sure this is real, and I won't see this until 2026 run rate. And then to get this, I'm really looking out to 2028. So this is a long bet. This is a long-term bet, right? And I think that's why people are saying, oh, okay, great. I'm in a holding pattern for a few years now. So the stock might be cheap at $20, but I actually think the way to look at it might be to look at these options. So I can get a leap, 2027 leap on this stock, and let's see, strike of 20, right? So we're right about there. So I could buy the 20 strike, sell the 30 strike as the last price. And actually, maybe what I would do instead of buying this one that's closer to the current trading price, this $25 strike, sell the $30 strike, you're in it for maybe $1 a share with $5 of upside. So if you really think this thing is a $35 stock by then, you're talking about a 5-to-1 return, or maybe you go out here, right? $10 of upside, costs you about $2 all in. Buy the 3, sell the 1. So I don't know, 10 to 2, 5x upside again, right? Just with a little more room to run. So I don't know, that setup might seem a little more interesting, right? Put a little less in it, because if you're calling the stock an upside optionality bet, right? But these guys could really be in a world of hurt along the way. Right? They've got to go from where they are now, right, which is here, to get here, and then they got to do a lot of stuff, and prices have to hang in there for them to get from here to here. So I don't know. A lot of things could go wrong. Pricing could really hurt you in the interim. You could have one bad year that winds up consuming a decent amount of cash, and then you're back to square one a little bit. So I think an option setup might be more interesting to me than actually owning the underlying stock, given the commodity nature. I think I said that. So anyway. I don't know that much about coal, but it's kind of interesting. It kind of looks like one of those, if you go buy a call spread and get like 5 to 10x upside, right? Own it in a really small weighting. That might be more interesting to me. So I keep it on my list for that. I'll probably watch this and we'll probably look at some of these other players just so I can get a better handle on the industry before opining more from here. So that's it. That's my story. That's my write-up. Check it out, valuedon'tlie.com. Let me know what you think. Let me know if I'm totally off base or totally missing something. That is Peabody Energy. Thanks.